We hear the same criticisms over and over. Younger generations are struggling financially because they buy too much avocado toast, refuse to work hard, and spend their days scrolling on their phones. But the actual economic data tells a different story. Because the cost of living has inflated so rapidly, younger generations currently hold 86% less purchasing power than baby boomers did when they were in their 20s. That financial gap cannot be closed by skipping coffee orders. The struggle is a direct reflection of a gap between wages and costs that has expanded for decades. To understand exactly how wide this gap is, we have to look at an identical life milestone. We are going to compare an average American turning 33 years old today to a baby boomer turning 33, separated by 34 years. The most direct way to compare these two eras is a metric called the home-to-income ratio. We simply divide the price of a median home by the median household income of that specific year. It tells us exactly how many years of total wages it takes to buy a house outright. When we apply this single formula across the generations, the data shows how the cost of entry for homeownership has shifted relative to what people earn. Let's start with the baseline. The average baby boomer turned 33 back in 1988. This was the year Michael J. Fox was busy filming Back to the Future Part 2. This chart visualizes the economic math of that year. The median home price in the United States was about $110,000, and the median income was right around $27,000. That leaves the 1988 homebuyer with a ratio of 4. 4 years of wages bought the house. That generation also benefited from distinct demographic advantages. The overall population was smaller, meaning far less competition for available housing. Plus, people tended to marry earlier, creating a surplus of dual-income households from a young age. Between low housing demand and a prevalence of combined incomes, the 1988 economy was structured to make home ownership attainable for the average young worker. Now we jump forward to 2022, when the average millennial turned 33. The median household income reached $70,000, but the median home price exploded to $433,100. The ratio climbed to 6.11, and the United States is actually on the lower end of this trend. In the United Kingdom, housing ratios have consistently stayed above 7 for a decade and recently breached 9. This line graph tracks the Case-Shiller Home Price Index in red against median household income in black. From 1955 all the way to the early 2000s, wages remained above the price of existing homes. The housing bubble caused a brief crossover, followed by a crash in 2010. But since then, home prices have moved vertically while wages remained flat. The black line no longer keeps pace with the red. At the same time, the cost of education has doubled. Average student loan balances at graduation tripled from $10,000 to $30,000. And because there has been a 250% increase in college graduates since 1970, the volume of applicants has diluted the value of a degree, keeping starting salaries stagnant. Today's 33-year-olds are stepping into a hyper-competitive labor market, carrying triple the educational debt of previous decades, while trying to save for a housing market that is outstripping their earning power. The economic environment today differs significantly from that of 1988, meaning financial strategies that worked for previous generations may no longer be sufficient to build wealth. The first step is defensive. To ensure you have capital left to invest, the general rule is that you must cap rent or mortgage payments at 30% of your gross monthly income. Keeping housing costs that low requires serious compromises, especially if you live in expensive coastal markets like Boston or Seattle. But without that margin, saving for the future becomes mathematically difficult. Once you establish that defensive boundary, building wealth requires a focus on capturing compound interest through tax-free vehicles, like a Roth IRA. This growth curve shows what happens when you prioritize time in the market. By consistently investing $400 a month into a Roth IRA, you can offset stagnant wage growth and build a tax-free balance of over $1.44 million across 40 years. To further outpace rising costs, many workers are now adopting a strategy of job switching. According to data from the Wall Street Journal, those who change roles every 1 to 2 years often secure salary increases between 10 and 30%, which is significantly higher than typical internal raises. The generational wealth gap is a documented, systemic reality. The math is harder today, but by recognizing that the old rules have changed and applying these aggressive new strategies, younger generations can begin to navigate their own economic future.